Welcome options traders. Well, as promised, this is part 2 of a video that I posted earlier in the week addressing a question, how much time to buy? And again, it's a very common question among new traders, and this was in response to an email that I received from somebody that had shares of stock and was looking to buy a put option for a form of insurance or protection for, let's say, an upcoming earnings report, or maybe just a general fear that there might be a market pullback over the next, let's say, 30 days. So the question came down to, should you buy, let's say, a 30-day option if that's the amount of time you thought you needed, or would it be better to buy perhaps a 60-day option and sell after 30 days? Or maybe buy the 90-day option and sell after 30 days. And we could go on and on with this. Is there some type of an advantage in going into longer dated options, but only holding for a shorter period of time? And that's what was answered in the first video. But now we're going to address the trade-offs. But the thing that you have to remember, that whenever somebody is asking a question like this with the cost of an option, is that the cost is always the extrinsic value, the time value, because that's the part that always goes to zero at expiration. No matter how much or how little time value might be in an option today, it's absolutely guaranteed to be zero at expiration. So in part 1, the assumption was that the stock price stays relatively quiet. So in that video, I assumed that we had a $100 stock and we were buying a $100 put option. And we're saying, okay, the stock's going to stay somewhere around 100. And is there an advantage into buying longer dated options? And in that video, I showed that yes, as you buy longer dated options, the cost starts to fall only so far. And then after that, it continues to fall, but at a very almost imperceptible rate. So the point is that after you go about 2, 3, 4 times the amount of time you think you need, there's just not much of an advantage. So again, to explain this graph, what I mean by this is that if you think that 30 days is the amount of insurance that you need, then 2 times would be a 60-day option, 3 would be a 90, 4 would be a 120, and so on. On the other hand, if it was a weekly option, and this was the 7-day option, then 2 times would be the 14, the 21, and the 28-day option. So the point is that after you go about 3, maybe 4 times as much time as you think is necessary, the cost really just starts to flatten off. Big drop off early on when you go out 2, 3, or 4 times the amount of time, and then not much of a benefit thereafter. But as I explained in that video, that is assuming that the stock price doesn't move, or at least doesn't move too much. So whenever you're talking about options or option strategies, always remember that if there's a benefit, let's say from the stock staying still, there's not going to be a benefit, or in other words, there's going to be a cost if you get big movements. Same thing with strategies. Let's say for a straddle, you need a very big price movement up or down to be profitable. Therefore, you're going to be penalized and take losses if there's not much of a movement. So that's why it's difficult to answer questions like this, because it depends on what the assumptions are. If you want to assume that the stock price isn't going to move much, or that's maybe a fear, then yes, buy 3 or 4 times the amount of time, sell it after 30 days, and you will greatly reduce your costs. But let's go back to the initial assumption. The fear of this trader is that the stock is going to make a big move. And so the question we want to address is, well, what's going to happen to these costs or these trade-offs now if we do in fact get a big change in stock prices? Is there going to be a benefit by going to longer dated options? Well, as I just mentioned, there is going to be a trade-off if we get price movements, because there was a benefit for no movement. We're now going to start seeing trade-offs. But let's also divide this idea into 2 categories, where we might get fairly small price moves, and then we'll look at a second scenario where we get very large moves. So let's start off with the first category, where the stock might make a relatively small move, whether up or down. And what we're looking at here is a table. These are various days to expiration. This is a 30-day option, 60-day option, and so on. This was the value that I used in part 1 for the at-the-money $100 put. So if the 30-day put is trading for 3, the 60-day would be worth 424, and so on down this column. But now let's fast forward 30 days. That's what this column is showing. 30 days later, the stock moves $5 in the money. So for this example, we were looking at the $100 put. So let's say the stock is trading for $95 after 30 days. What's going to happen to our costs now? Well, let's start with a 30-day option. If we paid $3 for it, 30 days later, it's at expiration, and therefore, because the option is $5 in the money, it's just worth the $5 of intrinsic value. So what was the cost of this hedge? The cost is the $3 that we paid over here. That was the extrinsic value that has now gone to zero. Now, I know some people are going to say, wait a minute, there was no cost in this case because you paid $3 and you could sell for $5. That's a gain. That's a mistake. Why? Because we bought insurance with the stock at 100, it's now worth 95. There's a $5 loss, but we could only receive $5 for it. We spent $3 to get that. There's a $2 net benefit, and that's because there was a $3 extrinsic value. And that was the cost of the hedge. On the other hand, what if we bought the 60-day option, trading for $4.24? 30 days later, it would be worth $6.08, assuming the stock is trading at 95. So this was a 60-day option. Now it's a 30-day option worth $6.08. What's the cost now? Well, if the stock is trading at $95, there is a $1.08 in extrinsic value here, right? $5 is intrinsic value. There's a $1.08 of extrinsic. And because we paid $4.24, therefore, the remaining $3.16, or in other words, the $4.24 that we paid minus the $1.08 of extrinsic value that's in this price here, leaves us a cost of $3.16. And if we go through the entire list with this same analysis, looking at the price that we paid, the price that it's worth 30 days later with the option being $5 in the money, what do you notice? Take a look at this cost column. The costs stay relatively fixed. So in other words, if the stock moves in the anticipated direction, this guy was fearful that it would fall, we're assuming it's fallen $5 in the money, it doesn't really matter which expiration you chose. The cost is going to stay about the same. Interesting. So if the stock stays fairly flat, we get a benefit by buying longer dated options. If it moves moderately in the anticipated direction, we don't really benefit, but we're not really harmed either. Well, what if it moves against us? That's what this column shows over here. The stock has now moved $5 out of the money. So our 30-day put 30 days later is worth 0, and therefore our cost is $3. 60-day option, if that's the one we bought for $4.24, 30 days later the stock has moved $5 up. So our put is now $5 out of the money, and it is theoretically worth $1.20. And therefore the cost to us is $3.04. That again is just found from the $4.24 that we paid for it, minus the remaining $1.20 30 days later. So that cost was $3.04. So if we go through this for the entire different days to expirations that we could have chosen, notice that our costs stay reasonably close to the same. A little more variation than we did when we saw them go in the money, but still not a very big difference in the cost. Well, now let's make the assumption that the stock makes large price moves, whether up or down. And the thing that you have to understand here is that if the stock moves far enough, all of your in-the-money options converge to intrinsic value, and they do so quickly. In other words, all of that extrinsic value will quickly go to 0, even though there still might be a lot of time remaining. That's something that most people don't understand. In other words, you're going to lose all or nearly all of your time value no matter which option you're holding if the stock makes a big move in the anticipated direction. So for example, let's go back to our table here. We're looking at a put option that had 30 days to expiration. It was trading for $3, but 30 days later, we're at expiration, and the stock is now moved $30 in the money. So the stock's trading for $70. Well, that put is going to be worth just $30 of intrinsic value, no extrinsic value, and therefore the cost to us was $3. If we had instead purchased the 60-day option for $4.24, but 30 days later, that option is also worth $30. And therefore the cost to us was $4.24. So take a look at this column right here. No matter which expiration we had purchased, all the way even out here to a 300-day option, that they all quickly converge to $30. So that's something that most people don't understand. If that stock makes a big move in the anticipated direction, that option goes in the money quickly or deeply, they are going to quickly converge to intrinsic value. So look at our costs now. Now we're getting very big changes in costs if we buy longer dated options. However, keep in mind that we also made money. If we had purchased this 300-day option for $9.49, almost $9.50, and it quickly goes to $30.45, yeah, we lost most of our extrinsic value, but we also paid $9.49 and sold for $30.45. We still made a lot of money. Not the worst thing that could have happened. On the other hand, what would have happened if the stock moved $30 out of the money? So we're looking at the $100 put, and let's assume that the stock rises to $130, so that all of these puts are now $30 out of the money. These would be the theoretical values 30 days later. And take a look at the costs. Again, much bigger cost for buying the longer dated options. And this goes back to what I said on a previous slide. If it turns out that it's an advantage in buying longer dated options when the stock sits still, it should be a bigger cost when it doesn't sit still. And that's exactly what we're seeing here. However, again, keep in mind, even in this case, if it moves up, we still made money. Why? This trader owned shares of stock. Yes, this put option went up in smoke, but his long position made $30 of intrinsic value. And the delta on stock is always 100, so he made the full 30 points there, lost in this case down here about $9.49. So overall, he still made money. And that is the most important thing to understand about part 1 and part 2 of these videos here. If you buy longer dated options, yes, you're going to come out ahead if the stock sits still. You're going to stay about the same if it makes moderate moves, and you're going to have much bigger costs if it makes big moves. But if it moves in your favor, you made money. If it moves out of your favor, you made money if it was a hedging transaction. So the hedging decision becomes fairly simple. Buy about 2 to 4 times the amount of time. And if the stock sits still, or at least relatively quiet, your hedging cost is reduced. It's going to be much cheaper for buying those longer dated options, even though you might be selling them with, let's say, 30 days till expiration. And if the stock sits still, your hedging cost is reduced. So even if we sell them with maybe 30 or 60 or 90 days till expiration, it's going to greatly reduce that cost if we buy longer dated options. However, if the stock makes a small move, whether up or down, that's not really going to affect us one way or another. Hedging costs are going to be about the same. So now we're still better off, in these two scenarios, by buying longer dated options. What if it makes a large move? Yes, your costs will be greater, but at least you made money. And if you think about the definition of a hedge, the benefit should be when you're wrong, not when you're right. And because of this, this is why most professional traders will buy more time than is needed and sell back any remaining time to the market. For those who'd like to know more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.